Yo, Jam, what's going on, man? We did it again, man. Yeah, we just keep swindling them. It's amazing. We just these IPOs, they're great, right? This is what IPO dreams are made of. We get in for like $45, and then these retail investors and all those other fools that didn't get allocations come in and they buy for $70. Isn't that amazing? Just like Snowflake. What a great time for us, you know. You know what, Jim? Just like we did with Snowflake and Airbnb and Facebook and all the others, we're going to pop some champagne tonight, baby. That you know what? I got the champagne already. So we're gonna be popping the champagne tonight. And for the rest of the year, as all these IPOs come, you know what? If Robinhood comes out, we're gonna 3x that. We're gonna get the IPO pop going, baby. You heard me. Yeah, we're gonna swindle them like we always do. You know what? I don't know what this is. Moet and Chendon. Yeah, we're gonna pop that, baby. Yo, Jem, you're not on air, right? You're not on air, right? You're on air. I met the SPACs. The SPACs, they're the scams. They scam the retail. They scam the hedge funds. They don't disclose enough information. You know, I'll call you later. I'll call you later, Jem. I gotta go. I got some champagne here. I'm gonna go. Gonna return this to the store because IPOs are legit and they don't do anything wrong to the companies and the retail investors. No one gets screwed over. We're all in the same playing field. It's all even. I'm gonna go return this champagne now. So I'll call you back later, Jem. Take me off air. Take me off air. Hey there, Lincoln here from bullacademy.org. Today let's talk about the IPO pop and all the hype around Snowflake, Airbnb, and any other big name IPO that the hedge funds and the institutional investors and the investment banks all get in on before the retail investors get to actually buy into these companies on the IPO day itself, and how they're all in on this very sick joke on around the IPO, and how these companies that go public through the IPO process, the traditional IPO process, leave maybe double or triple the money that they could have raised the night before on a roadshow, and on the day of the IPO, it pops. The price pops. So if a company goes public with a share price at $45, you might see it at $70 per share within a few hours of it going public. Same thing with Airbnb going public at $68 and is today 3x that at around 180 and went up even further than that on the IPO day because of the IPO pop. And the same thing with Snowflake, it went up more than double on the IPO day. A IPO at around 120 went up way above 240 and now sits around 220. So all of these prices are manufactured. The investment banks out there, when these companies go to them and say, hey, I want to go public and I need your help to do that, they say, okay, I got you. And then they call up their rich friends, right? Like Jem Cramer, their rich clients. They call up their guys like David Faber on CNBC and they say, hey, we have this private company going public. You're one of our most trusted clients and we love to keep your business. So if you want to get in on this company going public, we can help you do that. And they give them the shares of the company at a discounted price because they know that if they price the stock of this private company under what it can be in the public market, what they expect to be in the public market, they can manufacture a pop. And that pop will lead to more hype around the company going forward. So that's what they pitch to the company. They say, hey, you don't want to price your company too high. Give it to our rich clients for a discounted rate so that they can come in and oversubscribe and you get all of the hype around your IPO day because everyone's looking to buy in and it's so high and it's gonna pop and you get all of the hype and people love you going forward. But what the company doesn't realize, or what they used to not realize, is that they're leaving millions and billions of dollars collectively on the table because they're getting ripped off by these investment banks. And it's not just the private companies going public. It's the people on the public market. On the day of the public offering, the IPO day, when people buy in at that initial price, before they can even get into that, It's already ran up because of all the hype, because it was manufactured. The CNBC folks, the Fox Business folks, they say, oh my God, you gotta buy it. It's gonna be at $45. It's so valuable. They're gonna do so well at this, that, and that, right? And people who watch those shows buy it. They buy it. But what they don't realize is that after the lockup period ends, after 6 months, 3 to 6 months is usually around there, those institutional investors, the clients of those big investment banks that took the private company public, they get to sell off their shares. And they got in at half the price of what it is now, or maybe even 3 times less than what it is now in the case of an Airbnb. In the case of a Snowflake, half the price. And it's going to stay around that until that 6-month lockup period is over. And then the institutional investors who got their allocations before the IPO day, they're going to dump it. They're going to dump it, right? Not all of them. Some will stay, but many of them will dump it. But the problem isn't with them dumping the shares. That's their business. They can buy and sell whatever they want. The issue is that retail investors don't get the chance to buy in at that discounted rate. Most retail investors, that is. Because these investment bankers, their main customers, their customers in these IPOs are their rich clients. It's not the private company that they're taking public, and it's not anybody else who cannot afford to give them enough money to be one of their top clients who they can give a lot of allocations to at a discounted rate. So if you don't understand what I'm talking about, I've covered the IPO process many months ago, and I continue to talk about it and how it's a ripoff to retail investors and to the private businesses, and many of them have realized that. Take Slack, for example. Slack said, I'm not doing the IPO process. You guys rip us off. So we're going to go with the direct listing. We're just going to list our shares on the public markets. We're not going to issue any new shares. And then our private investors, our employees and other investors can go ahead and sell their shares once we're public. We don't need you, investment bankers. And Google did the same thing with the Dutch auction back in the day, like 2 decades ago now. So people know this. People know that these investment bankers, this IPO process rips off the private company and it excludes the retail investors like you and I. We don't get those discounted rates. We aren't called up by JP Morgan Chase, by Citibank, by Credit Suisse. None of them call us up and say, hey, we're taking Roblox public. Do you want to get in? So those institutional investors who get all those discount rates, they go on CNBC, they go on Fox Business and talk about how, oh yeah, the IPO process is the only legitimate way for a private company to go public. Anything else is a scam. And what that means is that those big cats on Wall Street, the CNBC guys, the Jim Crimers and the Fabers of the world, who are rich enough and connected enough to get in all those allocations, got a nearly 60% return on their investment in just a few hours. And if this holds, those fat cats get fatter and the wealth gap grows. Retail investors get screwed by not being able to actually buy in at the dollars per share that the investment banker's clients got. And the company also got screwed, like I've said over and over. This whole IPO process is the scam on the market. There is no other scam on the market but the traditional IPO process. Everyone knows that now. Google knew it back when it went public. Slack knew it when it went public. So people are realizing that the investment bankers work for themselves and their rich clients. And the SEC has screwed over the retail investors. But I have good news for you. I'm not popping champagne with Jim Cramer later. I went to the store and bought whatever this is. I don't drink, so I don't even know if this is a fancy champagne, but it was the most expensive one, so I bought it. But the reason I'm doing this video is that these fat cats on CNBC and on Fox Business and on wherever else, and on the Twitterverses, they're always talking about how SPACs, special purpose acquisition companies, are scams, and they screw over the retail investors, and they don't disclose enough information, and all this other nonsense out there. Sure, they could disclose more information. That's for the SEC to figure out, and that's for the investors who invest in them to discern. It's up to us to look into the details and invest. But the SPAC process is a lot more equitable than the IPO process. Why? Because we, the retail investors, get to buy in before a target company is announced. And when the target company is announced, we get a benefit from the pop too. When the SPAC goes public at $10 per share at the net asset value, we get to buy in at that price. The same price as the institutional investors, the same price as the PIPE investors, the private investment in public equities. We sometimes get better deals than they do. We retail investors sometimes get better deals in SPACs than the private investors, the rich institutional investors out there. Take CCIV, for example. The SPAC investors of CCIV got in at $10 per share, net asset value. And then when CCIV had to raise more money, the PIPE investors, the private investment in public equities investors, got in at $15 per share. That's a 50% premium, which means the retail investors who got in on CCIV at $10 per share got a 50% return on their investment thanks to that PIPE deal. That could never happen in the IPO. And that's great for us, the retail investors. We get a chance to get in on the ground floor. And we get a chance to get in on younger companies that have potential to become big players in their markets. Sure, there's more risk to it. There might be less disclosures. I haven't done any studies on that. I don't know what the facts are. But some people say that that's their argument. The SEC hasn't weighed in. They said they're going to investigate, but that's for them to figure out. But my SPACs have done very well for me, with the exception of one. You know which one that is. You can watch our previous videos on bullacademy.org to find out. I've made lots of money on SPACs as a long-term investor. I've done very well. And so have many other people who invest in SPACs. Because we were able to look at the data, look at the investor presentations, look at the projections, which are not facts, but future possibilities, and say, hey, is this management team good enough? Can I trust this team to actually deliver on these projections? And that's my choice. I don't need the SEC telling me what I can't and can do. I can look at numbers. I can look at people. I can look at their histories and see what they've done in the past, what they can potentially do in the future. I can read up on the technologies that are being proposed in the businesses, make my own choices. So I get to get in on the ground floor at $10 per share, just like institutional investors. So no, SPACs are not the scam here. The scam is the IPO pop, because the IPO pop leads to the institutional investors, the investment bank's clients, popping champagne, calling their friends up and saying, hey, meet me at the rooftop on Hudson Yards. And let's pop some champagne tonight because we just screwed over the private company and the retail investor. Same thing with Snowflake, same thing with Airbnb. When 6 months comes up, those guys get very rich. They get to offload some of their shares at a high premium, 2x, 3x, sometimes 4x, just because they're rich. By the virtue of being rich, they get to become more rich, thanks to the IPO pop. By the virtue of being rich, by the merit of being rich, because we judge knowledge and education on how wealthy you are. That's what the SEC thinks. If you're rich, you must be very smart to make your own choices. So hey, you get to invest in risky things and get big rewards. And we'll shut out the little guys so that you don't have any competition. And if they find a new way to beat this system, we'll call it a scam and we'll do investigations so that they get scared. And we'll make sure that everyone's on CNBC talking about how it's all scam and how you should avoid it. And we'll quote misleading studies about how, oh yeah, most SPACs after they're de-SPAC, after they actually go public with their merger, they underperform. If you take out the best performers. If you take out the best SPACs, then SPACs in general underperform. If you take out the best SPACs. Do you see how misleading that is? How disingenuous that is? If I have a bucket of apples and I take out all the good ones and leave the bad ones, the average ones, then yeah, this bucket of apples is no longer good. And they pass that off as scientific stats. That's what they all quote. If you take out the good SPACs, the best SPACs, then all SPACs in general are just scams. They all underperform. What they never follow up with is, no one ever asks them this, what if you take out the best performers in the traditional IPO? How well do those companies do then? How well do companies do in the IPO process if you take out the best IPO performers? No Airbnb, no Facebook, no Apple, no Starbucks, no whoever, no big names. Take them all out because they're the best performers, right? Take them out. They don't matter. Then tell me how well IPO companies do. Do they underperform or do they overperform? You know what? Actually, I'll do you better. I'll spot you a few. Take the S&P 500. Take out all the best performers in the S&P 500. Tell me how good the S&P 500 is then. Even with their best ones, they're at 7% per year, 10% per year. And you're going to tell me that you can't beat the market, you can't beat the S&P 500? IPO is the only legitimate way to go public because everything else is a scam, because everything else doesn't exclude the retail investor. And you guys gonna pop champagne because you get to screw over the private companies. It's divide and conquer. Divide and conquer. So they put out all these misleading stats. They go on CNBC, they go on Fox Business, and they tout all of their nonsense. And they brainwash their very audience to believe what they say. They say it ain't enough, and they believe it. So I just saw some guy on YouTube. I like this guy. He does very good videos, and I recommend his videos. It's very good. So I respect him. He's obviously very smart. The issue is he just did a video on SPACs, and as soon as I saw the title, I knew that it was going to be a folly. So most of the video was fine. And then he gets to the part at the end where he starts to caution about SPACs. And he says, oh yeah, you should probably stay away from them because although SPACs may be legitimate or whatever, if you take out the best ones, they underperform IPOs. They underperform after the de-SPAC. He stopped there. He didn't go any further. He said, if you take out the best SPACs, then SPACs underperform. Well, hey sir, can you finish your assessment? Can you give me a full picture here? What happens if you take out the best IPOs? What happens then? What happens then? They never get to that point. They always stop at halfway. They always stop at what's bad about SPACs. And the problem of what's bad about SPACs, in their words, the problem of that is that that's how business is. That's how anything is. The 80-20 rule. 20% of efforts account for 80% of the best results. 20%. So yeah, in anything, the whole stock market, the IPO history, the SPAC history, 20% of them account for most of the productivity. The other 80%, they're just average. Some mediocre. Some shouldn't be there. They have no reason to be there. So, yeah. If you take out the best of any group, then the group's gonna underperform. they never bring that up. It's like they stop at 1+1 and they never give you the answer. Well, they do. They say 1+1 is 1 because you took out the other half, right? And it has to underperform. So if you take 1+1, you take out the other 1, you get 1. That's what they do. They say 1+1 is 1. If you're dealing with SPACs. If you're dealing with IPOs, 1+1 is 3. 1+1 is 5. 1+1 is 10x. And the only person getting the 10x is the investment bankers' rich clients. And the rest of us just got to believe that it's all just how the way it works, just the way it works, right? So somebody's celebrating tonight. Somebody's going to be popping this champagne. It won't be me because I don't drink. It won't be me because I'm not an institutional investor. I'm not a investment banker's rich client. I'm just a lowly retail investor who doesn't know right for wrong, who doesn't know 1+1 equals 1, who doesn't know that green is good and red is bad, who doesn't know that projections mean predictions, which means in the future, which means not fact because it hasn't happened yet. I don't know any of that. I don't know anything. I don't have enough money to be smart enough because the only measurement of IQ, knowledge, and education is how wealthy you are or how wealthy you were born. So unfortunately, I spent lots of money on this champagne, but I don't get to drink it because I didn't get to participate in the IPO the night before. I didn't get Airbnb at $68 per share. I didn't get Snowflake at $120 per share. I was just a lowly retail investor who bought the hype and bought Snowflake at what, $250, $300? What did it go up to? Let's see. Airbnb is at $183. Its IPO price was $68 per share. $68 per share, and right now it sits at $183. $183. That's what they do to us. Let's see Snowflake. Snowflake IPO'd at, I believe, $120. Guess what it is right now? It's at $227, and its lockup period will be ending within 6 months of when it IPO'd. And the same is true for Airbnb and all the other IPOs that have ever been. These pops, they may look like they go down after the IPO hype, the pop, but in actuality, they're way up from what they were when the investment bankers' rich clients got to buy those shares. In essence, they're overvalued. Or, the other way to think about it is that they were undervalued by the investment banker who was trusted by the private company to take them public. And the investment banker went to their rich friends, their rich clients, and said, hey Jim, hey Louie, hey Sarah, do you want to get richer? Do you want to get richer? Well, I got this company. They're going public. They're going to get lots of hype. You can get them at a 2x discount, 50% discount. Airbnb, you know Airbnb. You can get them at a 3x discount. Snowflake, you want 2x? Here it is. That's what they do. So I'm obviously worked up because I just hate when these people are just so disingenuous. They give you half the story and just call things a scam. You know what happened with CCIV? CCIV had a pop from $10 per share to $65 per share within 6 weeks. You know who won from that? Retail investors. We got to participate in that. We got in at $10 per share, and then more people started buying it in because everyone started to realize that this is going to be a big one. Lucid Motors is going to be a big one. And the guys on CNBC, like David Faber, they got upset. And then what happened? The institutional investors came in and they bought it up. The hedge funds came in and bought it up. He just kept buying it up. Went up to $65 per share. So retail investors, like myself, who got in around $12 per share, we won from that. We got a chance to play the game too. And you know what else? Lucid Motors saw that and they said, hey, Churchill Capital, we see how much we're worth in the market. We see it. You can't screw us over. This is how this game is played. This is how the SPAC game is played. It's all transparent. We know what investors are willing to pay for us. So I want you to go out there and raise more money from PIPE investors, and I want it to be done at $15 per share. So increase what you're paying for us right now by 50%. So who won there? The private company won. The private company won. The private company saw what was going on in the market. They got a chance to say, hey, underwriter, I want more money because I see what's going on in the market. So give me more money. Go raise more money. And Churchill Capital had to go out there and raise more money, and they had to do it at a premium to respect the earlier investor because the earlier investor took more risk. So to reward them, they had to give them a return on their investment. That's how real investing works. Not all these rigged systems that the IPO process puts in place. The IPO process is not the only legitimate, and arguably is not legitimate at all because so many people, most people, don't have a chance to participate in that. And when that 6 months comes up, those who got a chance to participate, the rich, will get richer. And the poor will have bought on the hype at 2x, 3x, and 4x what the institutional investors paid the night before the IPO. And they will get burnt because they bought the hype. They bought the FOMO. So, I don't know what I'm going to do with this bottle. Maybe I'll just smash it. Maybe I'll just pour some out for my retail investor friends who got burnt, who will get burnt soon in the IPO of Airbnb and Snowflake once those lockup periods end. I don't know. What should I do with this? I don't drink. I don't like to poison myself. So if you drink, hey, I told the truth. Do you? But the truth is the truth. The IPO is more of a scam than the SPAC. The IPO screws over the private company. The IPO excludes the retail investor. The IPO enriches the investment banker. The IPO enriches the rich. And drinking alcohol is akin to poisoning yourself. The truth is the truth. That's all I can say here. That's all I do. But do you? If you like the IPO process and you've been convinced that it's the only legitimate way to go, hey, okay. I like my SPACs. I like a fair playing field. I like to make my own choices. So this started off as a fun video, but we had to get serious because there's always people out there with their own motives and their own biases, and I have biases too. My bias is not to get screwed over. The bias of the rich is to profit off of the screwing over of other people. That's it. But they don't mention it. So if you hear people on TV, on CNBC, talking about how 1 + 1 is 1, ask them where that other one went. And ask them if 1 + 1 is always 1. If 1 + 1 is 1 in the case of SPACs, then it must be 1 in the case of the IPO. Because math is constant, at least in our lifetimes. So we can't just pick and choose what is logical and reasonable. If someone gives you a stat, ask them for the other half of the story. Someone tells you what SPACs do wrong, ask them what SPACs do right. If they tell you what IPOs do right, ask them what IPOs do wrong. And if they pit the IPO and the SPAC against one another, ask them to contrast and compare the full story. Not just what they want to have you hear because it enriches them. I know I've mentioned Jim Cramer a lot on this video, but he's come around to SPACs more. His buddy David Faber is the bigger problem because he knows what he's doing. He's a smart guy, at least I think so. So I'm Lincoln, and that's been a rant, but I hope you enjoyed it. And if you did, like the video below, subscribe to the channel, hit the notification bell, and comment your thoughts below on the IPO process and the SPAC and all the SEC's practices and what you think about all of this. If you want to help the channel grow, reach more investors, get more access to me, and get direct answers to your investment questions, then join us over at patreon.bullacademy.org. And that's where we discuss the stock market and all the stocks and SPACs we're all invested in real time, and share our thoughts, news, rumors, and other ideas so that we can all make new investment decisions, better decisions, together. Collaborate and help one another build wealth, long-lasting, sustainable wealth together. And of course, you have a chance to win $200 every month just for being a loyal and engaged patron. So if you're interested in all of that, I hope to see you over at patreon.bullacademy.org. Oh, and I must say that because of our Discord channel, we've been able to get in on many stocks and SPACs early before everyone else had a chance, like SPE, CCIV, IPOE, and so many more. So this is another benefit of being in the community, collaboration. So I hope to see you over at patreon.bullacademy.org. I'm Lincoln with bullacademy.org. Thank you again and have a great day.